Not long ago, I spoke with a mother of two millennial children. Like many parents, she had worked hard, raised her family, paid her bills, and tried to make responsible financial decisions. She saved when she could, she contributed to retirement accounts, she followed the same financial advice most people have heard their entire lives. But as she got closer to retirement, she began looking back at all the money that had moved through her hands over the years. Money for cars, money for groceries, money for vacations, emergencies, college expenses, and everyday life. And she began to wonder, what if there had been a better way to position that money before she spent it? What if some of those same dollars could have continued working for her even after she used them for other purposes? That was when she learned about a financial concept she had never been shown before, a strategy designed to help your money perform more than one job. We call it the dual purpose strategy. This is not about working longer, taking unnecessary risks, or finding extra money in your budget. It is about learning how to position and move the money you already have flowing through your life in a more efficient way. Over the next few minutes, we're going to show you how the strategy works, why timing matters, and how the same dollars may be used to support more than one long term financial objective. After seeing the strategy, this mother said something that stayed with us. I only wish that I had learned this when I was younger. But she also realized it was not too late to make a difference. She was determined to make sure her two millennial children learned the strategy early and had the opportunity to benefit from it for the rest of their lives. By the end of this presentation, you will understand why she felt that way and why learning this strategy now could completely change the way you think about money. The mother's story points to a problem most of us never stop to question. The traditional financial system teaches us to separate our money into different buckets. We earn it, we spend some of it, we save some of it, and hopefully we invest some of it for the future. But each dollar is usually given only one job. When you spend it, it leaves your financial system. When you save it, it may remain accessible, but often grows slowly. And when you place it into a traditional retirement account, it may grow, but access can be limited, future taxes are uncertain, and the value may rise or fall with the market. Here's why this matters to you. Over your lifetime, hundreds of thousands or even millions of dollars may flow through your hands. The question is not simply how much money you will earn. The bigger question is, how efficiently will you use the money that is already flowing through your life? What if your financial system could be structured differently? What if some of your dollars could continue supporting your long term future while also helping you meet other financial priorities? That is the problem the dual purpose strategy was designed to address. Imagine this. Instead of using a dollar once and watching it disappear from your financial life, you first position that dollar inside a personal financial system designed to keep it working for your future. Then, when properly structured, you can access those funds for another financial purpose without interrupting their long term growth. One pool of money, two coordinated purposes. Long term growth for your future while helping you fund other priorities along the way. This is the basic idea behind the dual purpose strategy. It is not about earning more money, it is about helping the money you already earn to work more efficiently. Let's put this all in plain English. First, you place money into a properly structured financial vehicle designed to build accessible cash value over time. That cash vehicle is a max funded permanent life insurance policy. Max funded means that by IRS code, it is the most cash that you could put into it without it being called an investment. This allows you to access the growth of the cash account in the future, potentially tax free. Then, instead of withdrawing that money and stopping its progress, you borrow against its available value. The goal is to get a spread or arbitrage between the interest growth of the account and the loan interest rate. typically over the life of the policy around a 2% average annual spread. That 2% tax free positive spread will make a dramatic difference over your lifetime. Those borrowed funds can then be directed toward another priority, such as a Roth IRA or another retirement strategy. So one part of your financial system continues building for the future while another part is working toward a second goal. That is how the dual purpose strategy helps your money do more than one job. Let's make this easy to understand by comparing Bob and John. Both are 40 years old and plan to retire at the age of 65. Both contribute $10,000 a year into a plan until retirement age. And for this illustration, both use the same assumed growth rate on those funds. Bob follows the traditional path. He places his money directly into a traditional retirement account. His contributions grow tax deferred, but the money he withdraws during retirement is highly taxable. John uses the dual purpose strategy. He first places the same $10,000 into his properly structured financial system. Once cash value becomes available, he borrows against it and directs those funds into a Roth retirement account. This allows John's original financial system to continue working while his Roth account builds a second source of potential tax free retirement income. Now let's look at what the bottom line is. In this illustration, Bob receives approximately $35,000 a year after taxes in net retirement income through the age of 90. John receives approximately $72,000 a year in net retirement income through the age of 90. Same annual contribution, same illustrated growth assumption, but a dramatically different result because John structured his money to serve two purposes instead of only one. At this point, you may be thinking, this sounds really good, but what's the catch? That is a fair question. The dual purpose strategy is not magic and it is not right for everyone. It must be properly structured and designed, adequately funded and monitored on a yearly basis. Costs, loan interest, and performance can affect the results, and poorly managed loans can reduce available benefits or create tax consequences. That is why this strategy should never be approached as a do it yourself project. We have additional short videos that explain the risks, common questions, and important details more fully. For now, the key takeaway is simple. The concept can be powerful, but the structure and ongoing management matter just as much as the strategy itself. Here's what I want you to remember. The traditional financial system usually gives each dollar only one job. The dual purpose strategy is designed to help properly position money support two coordinated financial goals, building long term value while helping fund another financial strategy. But this is important. Not everyone will qualify. Eligibility can depend on factors such as your age, health, income, available cash flow, and long term financial goals. Even when someone qualifies, the strategy must be designed correctly for their individual situation. Your next step is to complete the short qualification form and schedule a personal strategy review. We will determine whether the dual purpose strategy fits your situation, show you what the numbers could look like, and answer your specific questions. The earlier this strategy is started, the better the outcome. So do not put this off. Click the link below, answer a couple of qualifying questions, and set a time to speak with us.